Good morning, John. It's good to see you. Second edition of The View for the year 2024. John, after very strong November and December periods for global markets, when share markets went up very, very strongly, bond rates came down, a lot of optimism about the year ahead. Now in January, for the first couple of weeks, it's almost a bit of a reversal. Do you think that this is a change, or just markets overshoot and we were probably a little bit overbought and there was a bit too much euphoria and we're now consolidating? What's your view?
Well, there was short-term overbuying. I look at the interplay of bond markets, as you know, Paul, and when the 10-year US bond and the Australian bond went from circa 5% to below 4% in the space of 6 weeks, you'd have to say that's an almighty rally, which is hard to justify. And whilst inflation's coming down, the bond market needs to get used to the fact that it needs to trade at a yield above inflation, not at inflation, because that's more normal than not. And the last 10 years, I know Howard Marks has said this, but I think he's just reiterating what I said months ago, that the last decade has been an extraordinary cycle. We've got the overhang of that, Paul, as the market tries to work out its true footing, its true valuation metrics. It's going to overshoot and undershoot and go all over the place. And markets are 24-hour beasts. We've got all these traders who have to do something every day, and they push and shove prices up and down, and then they write articles justifying why the market should go higher and then it should go lower. My focus, and I think our investors' focus, is on the longer term. And I mean, not next week, not next month. What happened last month, last quarter? About what's likely to happen in the next year or two. That's the only way you're going to make money. A pullback now is justified on overshooting, and you just got to look at, okay, if you're an accumulator of shares, at what prices do you pick up those shares, focusing on quality. Yeah.
John, there have been a few kind of hard data points released over the last little while. There was the China GDP number. I think it came in at 5.2 or 5.3, and a lot of commentary about China's population actually declining. So I know you've got some strong views on China. Would you care to share them with us?
I mean, it's a big economy, and it's a growing economy, and we've said this so many times, it's almost like a record. If China actually achieved 5% growth last year, Paul, that's almost close to $1 trillion US of growth on the previous year. That's 1% of world growth, just that number alone. The world economy is $100 trillion. So if China can put out $1 trillion, it's adding 1% to world growth. So the rest of the world, which is 82% of the world GDP, because just to look at the numbers, China's 18 trillion out of 100, so the rest of the world's 82. To get the world growth to 3%, the rest of the world doesn't need to grow anywhere near what China grows to get the world to grow at 3%. So I just put that out there. I think the analysis is so pathetic, and I think it's very much driven by entities who just want to trade markets and drive sentiment. China's growth, for the size of its economy, is fine. The population decline, I don't know how you count 1.3 billion people and come up with the actual population dropping by a couple of million. I mean, that's quite extraordinary. I just think that's a guesstimate, but obviously there's been deaths which followed COVID, and that'll come into the numbers, and probably on a delayed basis. But we all know China's population is not going to grow, but it's not so much whether the 1.3 billion people grow by 10 million per annum or decline by 10 million per annum for the next 10 years. It's really a factor of what the population which is living, what are they producing, what are they earning? Per capita is much more important than actual population numbers. It's much more significant to somewhere like India, who has 1.3 or 1.4 billion people, because their GDP is around $3.5 trillion US. So population is much more significant to lower your GDP. And that's, when you think about it, America's GDP is circa 28 trillion, and it's got 330 million people. So it's got a quarter of the population of China, and it's 30% bigger in GDP. So it's per capita, which is more important than actual numbers of people. And I just look at macroeconomists, and it's like, I mean, it's in front of their face, and they don't seem to see it. Anyone who thinks that China's GDP per capita is going to decline over the next 50 years has got rocks in their head. You know, it's much more likely that China's per capita GDP will double over the next 50 years than decline. I can tell you that. More likely to double. And what the world's got to get used to is understanding what that means.
Well, it sounds like you are very positive about Australia's export of commodities to China. You know, whether their population's going down a little bit, whether their growth is a little bit softer than expectations. The fact is, in absolute terms, they're still going to be sucking up a lot of our commodity exports regardless. So I assume that you're still very positive about that aspect of our economic growth.
Well, I'm just trying to be rational. You know, I don't think it's worth being excessively optimistic. I just think it's worth being rational and contrarian where the facts show that you shouldn't be following the facts. Now, China has gone through a quite significant property downturn, and we're seeing it in terms of actual prices, lending to the housing market. We've got it in housing starts, completions. I mean, every indicator of the housing sector of China is down significantly on where it was 1 and 2 years ago. Having said that, the economy still appears to have grown, and iron ore prices are twice what the Australian budget forecast and many international commentators, which the budget was based on, forecast. Now, if the iron ore price is sitting well above $100 with all those negatives, then you'd have to say the outlook for iron ore is pretty positive when the Chinese economy rebalances to a normal rate of consumption and production of steel. So I just caution people who are looking at last quarter numbers in China and reading way too much into it. I look at it the other way and say, well, if that's what's happening, and this is what I'm observing in terms of commodity prices, then I think the outlook for commodity prices is bullish, not negative, based on what the economy of China's gone through. And my final point, Paul, there's a lot of chat at the World Economic Forum, which is quite a funny place that all these people want to get to and give opinions, but trying to look at some of the outputs. There's a lot of push at Davos where the meeting is at for China to stimulate more through fiscal policy. And I go, well, 5% growth without stimulation of fiscal policy is not bad. If we look at America in the last 12 months, they've had a 5 or 6% deficit, fiscal deficit, to get 4% growth. So the commentary coming out of the Western world is so biased and so unbalanced that it's almost embarrassing when you step back and look at it outside Davos rather than being in that thought bubble of the Western economists who seem to be talking nonsense to each other.
John, some of the other hard data that has disappointed markets this week have been inflation numbers slightly above expectations. So whereas towards the last 3-4 months of 2023, we kept on getting good news about inflation falling faster than expectations. In the last couple of weeks, there's been a bit of a reversal in the UK, in Europe. It seems like the market has been a little bit disappointed and is now kind of pruning back their expectations of rate cuts early on in the year. What are your thoughts on that front?
Well, I think we made this point last week that the US is driving down inflation. The two big economies of the world, Paul, US and China. China's inflation's heading towards zero, and people saying, is that deflation? Well, it doesn't really matter. It's heading towards zero, and they're doing their darndest to keep their competitive pressures under control so they can export to the world economy and grow. But America's inflation's come down. And I think what's happened is the commentary around inflation got jumped on America and less so China, and that was the story of 2 weeks ago, and the story of today is, oh, inflation's not coming down as fast as we thought in UK and Europe. But we're talking 0.1 difference between what they thought and what they got. Now, honestly, and again, reading into inflation numbers, 1 month numbers and 2 month numbers, it's the trend line. The trend line is down for inflation. And what we've got to remember, all this rhetoric coming out of these commentary, that European interest rates are much lower than America, yet their inflation is much higher than America or US. So they're trying to justify interest rates staying where they are, and they should be higher, not trying to justify interest rates coming down because they're too high. It's all in the commentary and placing what they're saying in context. And I reiterate, European interest rates are too low, but they can't put them up because it's a low growth economy, aging economy, and their balance sheets are all in distress. America needs to get its interest rates down. It's done a good job, the Federal Reserve, of killing inflation. But as I said last week, a lot of that's come through the oil markets and reinvigorating oil production. Now that the commentary came out of America, which people watching this video will pick up, is now there's a review of how quickly interest rates can come down in America. Now, they're talking, was it going to be 6 cuts? Is it going to be 4? I don't know how you're going to get there, but it's going to be 1% over the next 12 months. Going to be 1% cut in interest rates in America. And even then, Paul, it'll be 4.5% against inflation of 3%. So, please, it's just going to happen.
Some of the older members of the audience will recognize that we're getting back to a more normal interest rate setting. Before the GFC and before the pandemic, it was quite normal to have interest rates which were neither stimulating the economy nor holding it back, around 4 or 5%. That was pretty normal.
Correct. And look, the only issue is when this all settles down and we get some rational thought process, is looking at the level of government debt and the cost of that debt through the bond market, and the ability of governments, as they roll their debt into more normal rates of interest, their ability to fund that debt. That's going to be the next interesting sort of conversational debate, and that we'll be watching that in coming months, Paul, as we watch the bond market settle at a level and try and understand, for instance, the American government, who's got $30 trillion of debt and probably has 3 or 4 trillion, if not more, rolling each year into 1% and 2% higher interest rates. How's that going to affect their budget?
Well, it's interesting. I wonder whether the fiscal position of the United States will be a topic discussed between the presidential candidates. Probably not. But anyway, John, I think we've got a little bit of time left to quickly go through the major ASX sectors just to see how you feel about them. First of all, just starting on the banks, do you have a view about the banks being kind of attractive in this environment where rates look like they're on a plateau, if possible, perhaps, and the economy slows down, rates come down a bit? What does that do to banks? Is that good for their margins, bad for their margins? Are you a holder of the banks?
Well, I think the banks are a core part of the portfolio now. I mean, the issues which we could see as mortgages rolled off fixed to floating, we've got through the bulk of that issue. A little bit more to go, but there's no stress appearing. It's been well managed. There's been no panic by the banks in calling in loans, so it's held them in good stead. Their capital ratios are strong. I always question their capital management. I'd like to see higher buffers in their balance sheet, not lower, or not managing to a buffer. But I think holders of banks can continue to be confident. The only question is, at what point do you look at some of the underperforming banks? Out of the 4 banks, clearly Westpac's been the underperformer, and then ANZ. And that's really a look at relative valuations and momentum coming back into the P&L. Now, if you've underperformed in P&L terms, the ability on stabilisation of bank margins and suggests there's probably a potential outperformance by some of the underperforming banks in a benign outlook for banks themselves. So that's my commentary there. But certainly you hold banks. And would you be overweight them? Well, overweight, what's that mean? I mean, is it overweight against an index? Is the index right? Who knows? But you'd have a fairly good holding in banks because the yield looks very secure and it's very well franked for pension investors.
Yeah, I think we tend to see CBA as the star performer, but it's very expensive compared to the other three. And I think in portfolios, we're mainly concentrated on National Australia Bank and ANZ. John, the resources sector, we tend to stick to the big leaders like BHP and Rio. Are you kind of maintaining your positive outlook on those companies?
Yeah, look, it's always an issue because they're volatile stocks. And the big question is, can you see out 2 and 3 years about sustainable growth, which will lead through into earnings growth? And then you've got the issues around commodity prices and currency conversion. So it's a lot more difficult than analysing a bank in common currency in the Australian economy. So having said that, I do think that they're both, the iron ore sector and the energy sector of Australia is well positioned in the world today. So, and that's Australia's great advantage is exporting commodities to the rest of the world. Now, there are sectors of the metals markets, a bit of a question mark appearing over lithium, as we know, because there seems to be endless supply appearing and technology improvements. So there's a bit of a question mark that takes quite a bit more analysis. But I think that the more industrial metals, they'll come back into play, and particularly because of the growth emerging out of India. And as I've written in a First Links article today, which I encourage people to read if they're not a member of First Links, it's free, but my article's there, and we'll probably republish it anyway on Client website. The outlook for the 4 billion plus people north of Australia in the Greater Asian region is quite good. And we're 26 million people with a $2 trillion US economy. I mean, it's hard to see Australia not benefiting from the Asian population and the improvement standard of living, which is going to be undeniable for decades ahead.
The property sector has been out of favour for some time now. Well, certainly elements of it. Office has been in the dog box, but industrial property has actually done well, and retail focused property perhaps hasn't really fully recovered from the pandemic. Do you have a view on where we should be with property exposures?
Well, the worst performing properties have been the ones which have been set in the last 2 or 3 years. It's always the late purchasers which get hit hardest in a devaluation cycle. Historically bought properties, and a lot of our portfolios have properties bought 5, 6, 8 years ago. Yes, they had a bit of a devaluation, but they'll bounce back. And the investors in those funds are not looking at capital losses. They're looking at a capital pullback against market price above their cost of investment, and they'll perform. Now, the property sector is very levered to population growth, economic activity, and because I think the further out you look, Australia's growth is assured, that all sectors of the Australian property market will perform. The question is at what rate. I think the performance of agriculture has been very good. Again, it's a cyclical type of part of the market. As you say, retail, clearly non-discretionary retail, despite what we're hearing out of Canberra in terms of inquiries into Woolies and Coles, non-discretionary retail will perform with population growth. And so, regional shopping centres, which are very anchored by non-discretionary, quite good. Discretionary retail, I think, will come into its own in the second half of next year. If investors want to be bold, they should position themselves before that's obvious, not after it's obvious, because the market would have done its job before you get there. Commercial, inner city, I think there's still issues there. Now, whether the pricing's right, it's more an issue of what's the outlook. And I think the outlook isn't as strong in commercial city as, say, commercial suburban. And that's just the work cycle, like the working from home and transport routes and the movement out of the major cities with businesses to more suburban areas or regional centres. So it's a slightly different thought process around commercial, I think.
Okay. I think we've basically run out of time, John. So perhaps next week we'll talk about some of the other sectors. We can talk about industrials. We can talk about healthcare. And also, for a long time, we've been emphasizing small caps as opposed to big caps, where there's a strong catch-up opportunity. But that's all time for this week, and we will see you next week. Thank you so much for your time.
Great. Thanks.
Okay.